Hello, everybody. Welcome to the show. My name is Stephen Choi, and this is Trading with Livevol. And this is where I trade my personal Reg T account, and I use LVX to trade, and you guys can see what I do. So basically, I talked about some of the trades that I like, that I have on. Basically, there's nothing going on. These are just marks. I have some butterflies. So even though it says I'm down 1,000, basically nothing's happening. The only trades I have is what I talked about yesterday. So I'm just kind of being patient and trying to figure out, more a better time to basically put on a trade. So let's just the market. Let's see if it turned negative. Yeah, so it just turned negative. Just I think in the past hour and a half or so. So as you can see, it's kind of, this is not, if you're long the S&P, this is not kind of what you want to see. And you can see the vol starting to kind of go up. So this kind of like indicator where the VIX is starting to kind of make a nice little U shape. And starting to, like, just by looking at it, it looks like it could actually go up. And then you can see that SPX is kind of weak. It makes it seem like it could have a bad day here coming up. Bad day, I guess, maybe means like down 1% or so. But it's not definite. So it's kind of like, this would concern me if I was if I had all these bullish position, but it's not enough for me to like start buying puts outright. That might change by the end of the day, but for now, that's how it is. So in terms of, I think this theme is basically in 2015 what I like. Generally, I think when there's quantitative easing going around, it's very bullish for the equity of that country or that region. So I did a little, just so you guys can kind of get a perspective of what happened in the United States. So you can see this is the monthly, and you can see the years down here. So in 2008, we had all this issue, and the first quantitative easing started. And then I think it was like right here in May, basically we started rolling over again. So we started our second quantitative easing like in 2010, right? 2010, sorry, right around here. And then it ended right here in 2011. And then basically in 2011 was when it ended. And then we had another one in 2012. So basically, like, as the market was rolling over, every time we stopped the quantitative easing, we started a new one. And the current one is the only one where we didn't really sell off. We sold off a few times, but if you're looking at the monthly chart, it looks like basically there was no news during this whole past couple of years, right? So now the same thing is happening in Europe. So naturally, I think just investing in Europe, and I think it's one of those things where everyone is telling you to invest in Europe, maybe even in Japan, because they're going through, both of those countries or region are going through massive amounts of essentially their own version of the quantitative easing, and which is very bullish for the marketplace. The only drawback is that while that's happening, the dollar is going up as well, which kind of, if you're getting it back from the the yen or the euro back to US, even if their market's going up, if the dollar is falling, some of these indices aren't that good. So it's one of these things. I think it's getting pretty crowded in terms of like everyone is like it used to be like only a few people talked about it like end of last year, but this year, especially now, when I watch CNBC, pretty much everyone is talking about to invest in Europe, which could be dangerous, but I remember everyone was piling short on oil, and it still just kept on going down. So sometimes the consensus is correct, and in this instance, I think it is. So there's a couple of indices that I like, and these are all indices that are basically dollar hedged. So if you look at this is the European index by Wisdom Tree. It's dollar hedged. There's also DXGE, which is the German hedge fund. There's no options for this, so you'd have to buy stock. And the other ones is basically the Japanese index, and I think this is the small cap Japanese index. So those are the ones I like. Just to kind of give you guys an illustration. So this is the European hedged, dollar hedged, HEDJ. But if let's say actually this is a better one. DXGE. So if you look at this one, this is Germany's equity market, but it's actually hedged, right? So you see how it's like pretty much making an all-time high. You can actually get EWG, which is also Germany, but it's not hedged. So you see how like it's actually not even gone to previous high, and that's because the euro has declined so much that basically your profit, most of your profit got sucked out by the dollar, or canceled by the dollar getting stronger against the euro. So, my general theme is that US for 2015 is that US is on a tightening, or at least the only country pretty much in the world that's on that path. So I think the dollar will continue to get stronger, which means, and then the rest of the world pretty much isn't on a massive quantitative easing or interest rate cut cycle. So I think in the end, what's going to happen is it's going to boost up their equity, boost up their profits, because now they can export more, especially a country like Germany and Japan that are heavy exporters. And so generally, I'm pretty bullish, right? The only issue here, let me actually, is like, look at this chart, right? So like, do I feel comfortable actually buying it here? I've been waiting for a pullback, but it hasn't really happened. So that's why I'm not in any of these indices right now. I'm waiting for a pullback. It might be a mistake. I think some of the things I can do is maybe doing some options to try to benefit from my viewpoint, even though it's high, right? So let's say you want to kind of start buying some calls, or you want to get bullish HEDJ, which is the European hedged fund, but now you just have to go and buy calls. So a lot of times what I try to do is if I think like in 8 months, whether it's like going up or down, it might actually go back down to like 29, and then maybe I'll recover, and then by August or so, maybe I'll be up here, right? So it could go down, but up. But my long-term view is that it's going to trend upwards, right? And let's say you believe that, you can either go in and buy some calls, you can either buy some calls, which a lot of guys do, or buy call spreads. Now, a lot of people buy call spreads like where they're buying the 65. So like you might, and I'll use up the complex. You buy the 65s and maybe you sell the 67s, right? Right, so you actually pay, like, let's say you get it for fair value, 90 cents, and then if it goes to 67, you're basically gonna more than double your money, right? So that's usually hold on. Right, so you're gonna make like 120% on that trade if you max it out, right? So that's kind of how a lot of people do it. They'll buy a spread while they're selling out the money. One other strategy that a lot of people don't use but might be interesting is maybe actually selling at the money, so or slightly out the money. So if you look at the stuff I'm working on here, so I'm trying to buy the 65 call spread for $1, right? And the HEDJ right now currently is above 65. So what that means is by August, if HEDJ is actually 65 or greater, I'm gonna double my money, right? Basically, my break even is 65. And if it goes 65 or higher, I'm gonna make money. So I'm gonna double my money on this trade, provided that HEDJ stays where it's at. So it's kind of the stuff that I like putting on. It's the same thing I put on in Twitter for the long term, because I like it because the premium on those at the money's long term is a lot. So you can put on these spreads, and if you have a viewpoint, you can actually put on X amount of dollars without having to risk as much, right? So what do I mean by that? Well, normally what people might do is they might actually buy the stock, right? So if you bought 100 shares, it'll cost you $6,500 to basically own 100 shares, and if it went up a couple of bucks, you'll make $2 on it, right? So you're gonna make like 3% on that trade if it goes up to like 67 bucks. Maybe if it goes to 70 or 75, that'll be great. So you're gonna make $10, which will be a 15% return, which is all good, right? So if you put in, if you bought 100 shares of HEDJ and it went up 15 bucks, or $10, and you made 15% over the course of the year, well, that's fantastic, right? So if you bought 100 shares, so you would have made $1,500, right, on that trade. So what I would do, and this is kind of like general kind of thinking, not so much like I have some specific formula, but instead of, if you think you can make 1,500, instead of actually investing 6,500, you actually take 1,500 and buy that call spread, right? So I wish they had January, but it looks like they only have until August. But if they had January, I'll be doing the January. By the August, let's say 63, 65 call spread for $1, just like the one I have here, right? If I do get it for $1, I'm gonna invest $1,500, and if I'm correct, I'm gonna double that money, right? So I'll essentially do the same thing, but I'll only invest $1,500 instead of $6,500 that I would need. So you can use that $5,000 for some other trade and generate income. You can pretty much, theoretically, you can kind of put it in like a bank and collect interest, except for the fact that there isn't, you can't collect any interest these days. But that's basically the principle, is that you put in 1,500, and then no matter what happens, the most you can lose is 1,500, right? So one of the benefit is if for whatever reason some craziness happened in Europe, like some massive terrorist attack, or there became some kind of an all-out invasion in Europe to Ukraine from Russia, like something that you wouldn't expect, right? So very low delta, but let's say it actually happens, then you can suffer losses greater than $10 or greater than 15% on this, right? So so that's another thing. You know exactly what you're risking, and you don't have unlimited loss down to zero. And so I think you guys are probably thinking like, well, that's great, Stefan. So what's the downside? Well, the downside is you'll lose actually everything if HEDJ goes to 64 or lower, right? 64 or lower is right here, right? So basically 8 months or 6 months down the road, if HEDJ is trading below this, then you're gonna lose. The August I don't like as much, but it's usually the summertime. There could be some sell-off. I would like to kind of have a spread where I get like the December effect, but it's usually in December you kind of get a run up. So I actually like that spread in December, not as enthusiastic about that spread for August, because I think there's a greater chance it could be below 64 during August time than in January of next year. But anyway, that being said, so that's what you're basically putting on is, you're putting this on because you think in the long run you are correct, right? And basically you're correct or you're push. So, let's say there's an equal chance of this ETF going up, staying the same, and going down, right? So let's say there's 33% chance of happening, going up, staying the same, or going down. If that is the case, you're going to win 100% of your money 2 out of 3 times and lose 100% 1 out of 3 times, right? So it's a pretty good bet, in my opinion, because you kind of get the long-term view and you can put it on. It's stuff that I did for Apple, Facebook, any company that I'm like bullish or bearish. I love putting this on. So, for HEDJ, this could be a good strategy. And as you guys can see, I'm already putting this in there. So it's kind of like, it's like a pseudo buy right position, except I'm using like just slightly in the money calls for it to act like as a stock. So that's kind of what I'm doing. I have the same kind of opinion, but the other opinion on stocks like XOM, right? Because I feel like oil's going down. Now, I think one of the mistakes I did is I'm still trying to like capture the short-term movement, and I need to do like a longer-term movement. So I think next time maybe when Exxon bounces is when I'm going to put on, and it's the same kind of idea, right? So let's say over the course of next year or end of this year, you feel like XOM is going to go down. What you can do is you can actually sell these maybe 87.5 and buy like the 92s or something, right? So let me actually click that. So it's a $5 spread and it's 285. So it's not really in the wheelhouse for me, because I would like to like try to but I would like to try to double my money if I'm correct, right? So sometimes what I do is, because this one is, maybe it has to go back up, or maybe I might do, it's too bad they don't have an 87 strike, because that would be better for me. But let's say I do, let's try the 80s, let's try the 90.85, right? So the 90.85, you might have a chance of getting it for 250, but obviously the 85 puts, it's actually out of the money. So that's why it's not really that great on this right now for me. But if I can double my money somehow, and I can get the options to line up, option prices, then it's something that's very appealing to me. For those of you guys who didn't hear Rex Tillerson, he's the CEO of XOM. He was on CNBC. I think I strongly suggest you guys look at his comments if you're interested in oil, of course, because there were a couple of things that he said that kind of was an important point. One, he was saying that the fundamental was that the demand was kind of decreasing and the supply was increasing. So there's a fundamental reason why oil prices was going down. He was saying that the US economy is recovering, but not enough. That European economy is basically not using as much oil, and China is decreasing the increasing per year. So basically they're dramatically slowing down on how fast they're growing their oil consumption, right? Another point he made was about how much oil that US has increased. So it seemed like he was a little surprised how much we have increased in the United States, which is like 1 million barrels a day. And just from what he's saying, he does not seem like the production is going to be cut anytime soon, mainly because he actually said that I don't think XOM is going to cut their production in the United States this year, or like, so I'm thinking like if the other companies are in the same situation, they probably aren't going to cut either. He needs a pickup in demand for the prices to go up, but obviously he was saying as we are storing more oil, those oils that we're storing has to be depleted before the prices can go up again, right? So in general, I actually, from that, listening to him, felt like he thinks that oil is going to go down further, and he didn't seem that positive on his own stock. And I don't mean in the long term, but I mean in the short term, maybe like the next year or this year. So I think it's an interesting thing to look at. I'm definitely bearish on the oil sector still. I know that's not like, I think that was pretty much the prevailing viewpoint. Now it seems like it's kind of changing. There's a lot more people who are calling the bottom in oil. But I think I will be interested to see what happens when we do start running out of storage, which could be sometime in April. So that's kind of my my viewpoint on what I think is going to happen in 2015. Basically, investing in European indices or Japanese indices, or basically any other, maybe India as well, but I don't know anything about India really. But essentially, like those kind of places where everyone is trying to devalue their currency, and they're starting their own QE programs, because we've seen that before in the United States and how beneficial it was to the stock market. So that's my thinking. The only negative, in my opinion, is the fact that you have the currency risk, so you need to pick stuff where you won't be affected if the dollar goes up, and because you think the dollar is going up. So in UUP, I had the same scenario. Now that I'm talking about it, essentially I had 200 shares. So if you saw my shows before, I had 200 shares, which I put $5,000 basically into this investment, and I bought it, let's say, for 25 bucks. So at 200 shares, I would have made $100 on that trade so far. But I kind of sold my 200 shares and I bought 13 of these 24 strike, you know, let's just say for like 140, right, or 145. So I put like fraction, like a third of the capital, and now I'm getting leverage where my calls are pretty much acting as though it's about 1,000 shares. So even though I'm investing a third of what I'm investing in terms of my capital, I'm actually having a synthetic of owning 1,000 shares versus owning 200, and that's where the options are astronomically powerful compared to trading stocks. So there's no way people who are seriously about investing and trading should just trade equity without options, because no matter what your viewpoint or what your time horizons, doing it with options overlay is basically the way to go. And in this instance, because I felt like the 24 strike in UUP was pretty much same as stock, and as you can see, I have until January to profit from it. You know, I was thinking of adding, you know, I think I talked in previous shows, I would like to have around 50 of these. So I have 5,000, but I'll see how it goes. So, you know, this kind of caught my eye, 283. I click on it, and I see all this stuff, right? So a lot of times what I would do when I was a market maker, because of margins and to give me flexibility, I'll buy puts like this. Like I'll buy, you know, a few hundred of these. Like let's say I'll buy like 300 of these, and then I'll buy 30,000 shares of UUP. It's essentially same as buying these calls for 173, including like back then when you had more, there was like the cost of carry. But since there's no cost of carry really, basically you essentially, it's synthetic as buying the calls, but the advantage you have is now you can scalp stock. So you see how UUP is up a lot today. You know, if you were long, you might say, hey, this is kind of like, I think it might go down a little bit. So you might sell, you know, like a 10% of your holdings. Hopefully it goes back and then you can buy it. So you can actually scalp by owning puts and stock, whereas like trying to scalp the calls itself is pretty much a loser. So like I'm stuck with this, but you know, I have a retail account. If I was a professional, I'll probably buy puts and stock. I would have the same kind of margin, even less. So I would need like, I think 16% of what I'm actually synthetically paying for on these options, and I can hold that position. So it's tremendously powerful, but you can do it by just owning the calls. I was thinking of maybe selling the 27s, but you know, I kind of want the option to kind of sell some of these as UUP goes up, and if you are short these, you can't sell it. So yesterday these were lower. Let's see. Right, so yesterday they were 30 cents, today they're 35 cents. So as UUP goes up, it's only gonna go higher. So like, even though this went up 0.5%, these options went up 1/6, which is like 16%, right? So that's tremendous power on these out of the money options. And now, if you had a call spread and you wanted to lock in some profit, you actually have to buy this thing after it increased 16% overnight. So it's not really that great. So usually I like to own extra bullets. So that's how I would like to do it. So that's about it for today. If anything is confusing, don't worry about it. Just kind of go back and listen to the segment that interests you. And I'll touch on this probably, you know, for the rest of the year, since I'll be trying to make trades on it. So I would like to buy some more UUP, basically try to get into the indices I just talked about, like HEDJ, DXJ, DXGE, but it's just been like such a tear. You know, I wish I bought it like I wish I bought it like here, but like at, you know, I remember like beginning of this year, I was thinking like, oh man, I'll wait until the pullback. Never really pulled back. this is, I guess, would have been my only time, but I actually thought the market was going to go down further. So I thought I was going to get it at the lower Bollinger Band, which was obviously wrong. And now it's actually ripping up again. So, you know, who knows? I might not get it. If I don't, then I don't. But I'll just wait until it sells off, try to get it that way. So hope your trading goes well. I'll talk to you guys tomorrow. And, you know, hope you guys make some money. Take care.